Lecture 4. Analyzing and Interpreting Financial Statement. As we have seen in the previous lecture, the financial statement has several steps. We always begin with assessing the business environment. Then we move to the financial transactions, then financial statement analysis, especially ratio analysis. So in order to meaningfully interpret financial statement, we need to understand the business. So we need to understand the industry. We need to understand the environment in which the company operates. For example, we need to check, the competition of the industry, the business. Is it very competitive? How many competitors do they have? Who are their customers, and who are the vendors? So does the industry need a lot of technologies, or it's a need heavily on capital? Okay, so these things are not focus of this course. And if you're interested, you can always go to the Porter's 5 forces analysis. So in Porter's 5 forces analysis, the 5 forces are the threat of new entrants, bargaining power of buyers, bargaining power of suppliers, threat of new substitutes, and finally competitive rivalry. So we may have a lot of resources to study the industry and the company, but here is a place that I suggest you use to study the business environment. If that is, if you log into the UHV library, and find a database, when you log in, you should be able to see all the database we have. And a specific database we want you to take a look at is the IBIS. The IBIS what? IBIS will provide researched information of U.S. industries. So if you log into the IBIS, it will enable you to see everything the IBIS world has. So pick industry that you're interested in. For example, if you're interested in the the automaker, or maybe the electric vehicle, If you're interested in the hybrid electric vehicle manufacturing industries, for example. So it will give you everything it has researched. This page will give you everything at a glance. Then if you click performance or the competitive forces, or the company involved in these industries, external environment, everything it has. Take a look at it. Maybe it's going to be useful for your project or your own purposes. For example, investment purposes. Next, we talk about vertical analysis. The vertical analysis is going to help us to understand the financial performance from the financial statement directly. So basically, we're going to convert financial statement to ratio form. So income statement items will be converted as percentage of net sales. Then balance sheet items will be converted as percentage of total assets. Therefore, it's easy for us to analyze different companies because they may have different sizes, right? It's not easy to compare, but once they are converted into percentage, it's easy to compare these companies. And also, it's easy for us to compare companies between themselves across years. So here we have examples, PepsiCo, in which we convert the income statement into the vertical format. So you can see the 2020, 2019, these are the original income statement. So what we're going to do is we're going to divide all these numbers, everything, by net sales or net revenues in this case. So net revenue divided by revenue is 1, and it will give us 100%. Then the cost of sales now is 45.2%, and the gross profit 54.8%. Net income 10.2%. That's for 2020. Now, if we convert 2019 results, and we can easily compare these 2 years' performance. What can you see? Right, compared with 2019, see obviously the gross profit has decreased, right? It is significant, although the number is small, but see a drop in gross profit, and also increase in expenses. So the net result is we see a drop in net income, right? So similarly, when we get the balance sheet, okay, we're going to convert them into vertical analysis by dividing everything by their the total assets, right? So everything divided by total assets. The total assets will be 100%, and the rest will show the articulation of the 100%. So what are the percentage? For example, cash equivalent 8.8% for 2020, and 7% for 2019. See, the cash increase is in terms of the percentage increased a lot, significantly. Right? Then I move to the liability sections. You see the long-term debt has increased. Likely the company has borrowed significantly. That is a big change. That possibly explains why the cash amount has increased. So, as you can see, although the vertical analysis may not tell us what actually has happened, but it gives us a summary, give us some clues to find out those answers. So when you analyze the companies, you're going to focus on likely what happened to the long-term obligations, right? Why they borrowed, okay? Where they have spent those money, okay? All right, so this is a vertical analysis. Next is horizontal analysis. Horizontal analysis examines changes in data across time. So when we try to compare this year's with last year's performance, we can do the horizontal analysis, right? The calculation is second year's amount less the base year amount divided by base year amount. This gives us a percentage of change. And here is an example how we calculate the revenue changes, right, for PepsiCo from 2019 to 2018 to 2020. So basically from 2019 to 2020, revenue has increased. So the 2020 revenue less 2019 revenue divided by 2019 revenues, it's going to give us a 4.8% revenue increase. And if we do the same thing, we find the increase was 3.9% from 2018 to 2019, right? So you can see the revenue increase has accelerated, which is good. But when we look at the operating profit, you see the increase was 1.8 from 2018-2019, but the operating profit, right? There's no increase but decreased by 2.1%, but something must be wrong with the operating expense side. So next you're going to look at what happened to those expenses. All right, so same thing for net income. For 2018 to 2019 dropped significantly, although the revenue increased, but net income dropped that much. So you need to study what happened. So the drop in net income, 2.4%, that is explained by the drop in operating profit. So these numbers definitely need to study what happened in 2019. All right, next we are going to talk about ratio analysis, but before we do that, where can we find those financial statements? Okay, basically you can find financial statement everywhere, but I will introduce a place to look for financial statement. That is the SEC, the EDGAR database. All right, when the company file their documents with SEC, they can upload their filings to SEC EDGAR database, so we can find everything companies have filed for many decades. So what we're going to do is we're going to click search filings SEC, or just click EDGAR, but I'm going to click EDGAR. Right, so here we're going to type any keyword of the company, ticker, or the name. So for example, I'll just look at Apple, right? So there's a lot of Apples, but this is Apple Incorporated. That is AAPL. That's a ticker for Apple. That is Apple we're talking about. There are other Apples. All right. So when we click, it's going to show everything Apple has filed. For example, 8K is used to file any announcement event. Then filing 4 is for inside trading report. When any insiders buy and sell, it will be used. The company we need to file form 4. So what we are looking for the financial statements. So I'm going to check the filing categories, during or annual, quarterly. Alright, so if you pull down the 10Q is quarterly reports. You can find financial statement for quarterly results, but we're going to use annual results, which is 10K. The most recent one was filed on November. Okay, that's for their fiscal year ended September 30th, 2023. So I'm going to click the 10K. Right, so this is going to give us a 10K reports for Apple. I'm sure this is a HTML version of 10K financial statement. Easy to read, but it's not good for us to work on it. So I'm going to open filing. Now, right, this is the HTML version or the XBRL version of the 10K. So a place we can download interesting stuff is click in the interactive data. Right? And here if you click view Excel document, right, so it has been downloaded now. Alright, so it has been downloaded. So it is an Excel file containing everything Apple has filed in its 10K report, starting with the front pages, cover pages, auditor informations, but we're looking for the financial statement, which is first, right? This is a consolidated of operations. In other words, that's a income statement. You see the net sales, right? Everything. That's income statement. The next one is change in equity, right? Or stockholders' equity report. The next one will be the balance sheet. Then we have the other statement, including this one. This is a statement of cash flow. All right, so all the footnote will be published in other sheets. Right, but we're going to focus on the financial statement. All right, so we can begin our work by inserting a new worksheet. For example, I can calculate this ratio, right? Ratio analysis. All right? Now let's talk about ratio analysis. We're going to talk about 3 types of ratio analysis. Return on investment. Then we talk about how to decompose the ROE, return on equities. And then we talk about ratios about liquidity and solvency. Basically, that's profitability and a risk, right? So if we measure profitability on the perspective of shareholders, we have this ratio, return on equities. $1 investment is going to bring us, for example, $1 profit. Then the return on shareholders' investment or equities is 100%. That's the idea of return on equities. And return on equities can be expressed in 2 other ratios. That's return on assets and return on financial leverage. Right, for example, we know the $1 is from shareholders' investment. With $1 investment, I can borrow another $4. So I have $5. Total assets will be $5. Then return on assets will be 1 over $5. That's only 20%. Okay, but we return on equities 100%, meaning, right, our return on financial leverage in this case will be 80%. So we used a lot of borrowing or financial leverage to increase our return on shareholders. Right, a return on equities. The calculation is net income divided by average investment. So average stockholders' equity. That's a formula. So ROE is a primary summary measure of company's performance from a shareholder's perspective. Right here we have example for PepsiCo's. So the calculation, if we have net income for 2020 and we have the numerator, right? The denominator is the average stockholders' equity. So to get average numbers, simply we can just take the average number from the 2 ending equity from 2020 and 2019. So we're going to get the average number. So PepsiCo 2020, our ROE is 50.5%. So interpretation is PepsiCo generated a profit. It's about 51% for every dollar, right? Shareholders have invested throughout the year. Now, what is Apple's ROE for the fiscal year 2023? So let's go back to the Excel file. ROE of Apple equals what? Right here we can build a formula to get the ROE for Apple quickly. So it equals, right, net income, which is the net income for 2023, net income, right? its number is divided by the average of shareholders' equity. So I need to find the balance sheet. The shareholders' equity, the total shareholders' equity, right, plus this one divided by 2. All right. We'll show this as a percentage. All right, that's well above 1. Astonishingly high, 172%. Every dollar investment, the return will be 172% of that. That's quite a lot. All right, so this illustrates how we can calculate ratios directly in a financial statement by using the Excel formula. So for the rest of the lectures, I'm not going to use it to work in this Excel sheet, but you can do that easily with this Excel file. Now let's talk about return on assets. Right, so we know their total resource of the company is measured by their assets, and we have two sources. Right, one is the equity, the investment by shareholders. The other is borrowings. So return on assets measures the return earned on each dollar the firm invests in assets, regardless whether this asset is financed by shareholders or financed by borrowings. So the calculation is earnings without interest expense. Right, so we're gonna add back our interest expense effect and divide it by average total assets. So why we need to add back the interest expense is because interest expense is returned to creditors, and now we are measuring the whole return on assets, so we need to, including the equity shareholders and creditors, so we need to add back interest expenses. To be more specific, okay, that's interest expenses multiplied by 1 minus the tax rate. 1 minus by tax rate. It's because interest expense is tax deductible, and when we add back those interest expense, we must measure them as a net of tax result. So for example, we have $10 interest expense. Okay, it will be subtracted from our revenue, and when we calculate net income, assume we have a 30% tax rate, right? It's going to save $3 tax expense for us. So the net result of the $10 interest expense is a $7 expense, a $7 reduction in our net income. Okay, so when we add back the interest effect, we need to add back the $7 effect instead of $10. So here's a calculation of ROA for PepsiCo. Now this net income plus the net effect of interest expense divided by average total assets give us 9.5% return on assets for PepsiCo. So the PepsiCo generated about 10% of profit for every dollar, right, in its average assets throughout 2020. I'm sure this ROA for Apple will be much higher than PepsiCo. So we have seen the relation between ROA, and the return on financial leverage. So now we're going to calculate the effect of the financial leverage on firm's profitability. So basically the difference between ROE and ROA is return on financial leverage. This is how much we profit right, from using the capital from lenders, creditors. So if we, as the shareholders, if we notice our profit, okay, will be higher than the interest payment, we can always borrow money to increase return to shareholders. But the more we have borrowed, the higher the return for our shareholders, the ROE. As you can see, the 2018, the huge amount of return from the financial leverage because of the PepsiCo very likely loaded a lot of debt 2018. And the calculation is very straightforward. Just by taking the difference between ROE and ROA is going to give us the return on financial leverage. For 2020, that's 41% approximately.